Tesla just reported Q3, and the headline's not great. They earned 50 cents a share when Wall Street wanted 58. Revenue came in roughly on target at $28.1 billion, and the stock's down 2% after hours. The problem isn't what they sold, it's what they made on it. Start with the earnings miss, 50 cents per share against a 58-cent consensus. That's an 8-cent whiff. Worse, it's down from 72 cents in the same quarter last year. Revenue of $28.1 billion grew 12% year over year and basically matched estimates, so the top line held. But profitability, that's where things fell apart. Tesla moved 497,099 vehicles in Q3, a 7% increase year over year and a new record. Energy storage had a monster quarter, 12.5 gigawatt hours deployed, up 81% from last year. Megapack demand is screaming, and the core Model 3 and Model Y lineup kept grinding. On paper, the volume story looks fine. The issue is the margin story looks terrible. Total gross margin landed at 18.0%. down 185 basis points from last year. Operating margin dropped even harder, 5.8%, a 501 basis point year-over-year collapse. Tesla's making less money on every car it sells, and the culprits are pretty clear. They've been leaning on cheaper models and promotional pricing to keep delivery numbers up. Tariffs are biting across multiple regions, and regulatory credit revenue, which used to pad the bottom line, has basically dried up compared to last year. Automotive gross margin, excluding credits, the number analysts actually care about, is under serious pressure. Management didn't give specific EPS guidance for Q4, but they did flag macro uncertainty, trade policy volatility, tariff headwinds, and softening consumer demand for big-ticket items. They're not projecting confidence heading into the end of the year. The stock dropped 2% after hours, and it makes sense. Revenue growth doesn't matter if you're torching profitability to get it. The real question now is whether this margin compression is temporary, maybe Cybertruck production scales, maybe energy margins improve enough to offset auto weakness, whether Tesla's stuck in a structural pricing war that grinds earnings lower for the foreseeable future. Tesla's delivering record units and crushing it in energy storage, but they're doing it at a steep cost to the bottom line. Volume growth without margin recovery isn't a win, it's a warning sign. If profitability can't stabilize as production ramps and mix shifts, this Q3 result isn't just a bump. It's the start of a trend Wall Street won't tolerate for long.